Trade Desk just posted a perfect earnings report. Beat revenue, beat earnings, business as usual. The market's response? Sending the stock down 40%, one of the worst days the stock has ever had. Despite what you may have heard, this isn't about the CFO leaving. It's not about light guidance. They actually guided slightly above estimates. This is about a specific fear pattern the market can't stop repeating. Amazon's name came up 22 times on that earnings call, and that triggered one of the market's biggest fears. But this is a great opportunity for contrarians. You see, when this pattern emerges, you get one of the easiest and most controversial trades in the market, the regression snapback. Now, I know you've heard this one before. Don't catch a falling knife. But contrarians like myself set up screens and wait for this type of trade. And over the next several minutes, I'll show you exactly how to copy my screen, including a 3-step filter so you too can invest in compounders while they're on sale. By the way, I'm Mark Jones. During the day, I run my fund, Pragmatic Capital, where we leverage deep research to build a concentrated, contrarian portfolio. But right now, I'm here to share those same contrarian insights, including the skills and mindset behind them, so you can lift the growth ceiling on your own portfolio. Okay, so back to why we're here, the repeating pattern in the market. I've seen this over and over again over the last 15 or so years. A stock drops on fear. Fear proves false. Then a massive relief rally takes over. More times than not, it happens within 3 to 6 months. The stock bounces back to pre-fear levels. A regression. One, that's an easy 30% or more for starters. In the Trade Desk case, it's a lot more than that. But you also get something much, much better. A deeply discounted cost basis and a proven compounder. Now let's get to the core of the repeating pattern that excites me so much. You see, the market has fears, just like you and just like me. And when fear kicks in, the market doesn't think, it reacts en masse. Visceral, predictable, every single time. You see, the market never shows courage in the face of fear. And right now, the market is terrified that big tech will crush small tech, as I call it. The sell-off started during the call. People didn't even have a chance to process the information, and that's how quickly that fear takes over. This big tech fear hits at least a dozen stocks every year. It's like clockwork. The only question is, which stock is next? And the reality is, you've probably seen this in your own portfolio. Remember when Amazon launched Handmade to target Etsy's business? Well, that new venture caused Etsy stock to drop 40%. Handmade ended up getting 500,000 listings. Suppliers didn't even want to be on there. Etsy adds more products in 2 weeks. Suppliers love Etsy, so buyers love Etsy. Stock goes on to multiply like it never happened. But let's keep going down memory lane. Remember when MongoDB got cloned by Amazon? Well, the stock dropped 15% in 3 days on that news. This business went on to post over 70% revenue growth in the next quarter. Stock went on to more than double just 6 months after DocumentDB. You know, we should go over a couple more because we really need to prove this big tech fear is real, because when you see it, you'll be able to see it forever. Remember Facebook Rooms, the Zoom competitor? Zoom's stock ended up falling 12% on this launch in April of 2020. Last check, it doesn't even exist anymore. Facebook Rooms is gone. And we know what happened to Zoom stock afterwards. How about when Roku crashed 27% when Apple TV Plus was announced? But growth never stopped and the stock bounced back. Or how about when Slack fell 15% on Microsoft Teams news, then sold to Salesforce for $28 billion? You see, we can see the fear even outside of small tech. Remember when Kroger dropped 9% when Amazon bought Whole Foods? The market was in terror over this. Wall Street said grocery was finished. Articles are printing all about it. Today, Kroger thrives like nothing happened. Yet Amazon has less than 3% market share. That's not by chance. So as much as I can keep going, I think the point has been made. Now think about this. The same people panic selling Trade Desk today will panic buy tomorrow when Trade Desk keeps winning ad budgets because of their fierce control over their corner of the ad market. You see, status quo becomes the catalyst, and that's the opportunity. The market creates fear. Then it creates its own relief rally. And I've designed a Contrarian screen that is designed to catch this exact situation. How do we know this isn't different? How do we separate real threats from the false alarms that create these opportunities? That's where my divergence test comes in, and I am excited to share it with you. But first, context. The first signals that the market is wrong is hiding in plain sight. Just pull up the earnings call. How did Jeff Green, the Trade Desk CEO, handle the Amazon questions? Was he defensive? Was he confident? Were his answers supported by data? Were they qualitative? He didn't flinch. He called Amazon what it is, another walled garden, just like Google, just like Meta. And we can just look at the data. 19% revenue growth. Kokai, their platform product, had an adoption of 75%. Clients using AI increased spend on the platform 20% faster than those who aren't using AI. That doesn't sound like a company losing to Amazon or in fear of losing to Amazon. But here's the key insight. Advertisers don't want the same company selling them ads and deciding their ad plans. That's Amazon's weakness. That's Google's weakness. That's Meta's weakness. Sure, they have a lot of strengths, but they also have weaknesses. You see, the Trade Desk's objectivity is their moat. Here's a pro tip for you. Know your CEO. Because while Wall Street analysts are saying that Jeff Green didn't really go on the offense as much as they thought he would, the reality is if you knew his style, you would see that he never attacks potential supply partners. He was diplomatic with Netflix for years. And when Netflix opened their platform up for ads, Trade Desk got access. Now they're doing business. He's playing the long game with Amazon too. You see, management's not worried. They're accelerating plans. If Amazon was crushing them, you'd see it here. The reality is they're launching enhancements like nothing is wrong because for them, nothing is wrong. That's signal number one. Now let's turn to the divergence test. Let's run the divergence test. Let's walk through this together. First check, earnings history. Trade Desk has beaten revenue and earnings estimates quarter after quarter. You see, that doesn't just happen. That's competence. Second check, revenue growth. Still compounding high teens year over year. Down from hypergrowth, sure, but it's healthy scaling. Advertisers are still spending, still expanding campaigns, still choosing Trade Desk. Now, third check, margins. We can see that Trade Desk margins are strong and stable. The reality is this business has been printing cash for years while growing double digits. You see, you don't maintain margins like that if Amazon's eating your lunch. And fourth check is short interest. It's elevated, but it's not extreme. You see, some shorts will no doubt be betting on Amazon crushing the Trade Desk. But when that doesn't happen, they'll be buying back at much higher prices. So that's 4 tests, 4 confirmations. You've got clear data showing that momentum is intact. But you've also got a stock that's down 40+%. That's the exact level of divergence that you want to see. But I've got one more filter for you that will really seal the deal. And this is something that I encourage you to use anytime you find yourself in this situation. It's the flywheel impact analysis. You see, every scale business has a flywheel, a self-reinforcing cycle driving compounding. Side note, I strongly encourage you to check out Jim Collins' work on the flywheel. The crux of it is this. Once a flywheel spins, it creates momentum. Now, the question today is, can Amazon's DSP break the Trade Desk flywheel? Because if not, the threat is fiction, and we know what's going to happen with the stock when that becomes apparent. Here's Trade Desk flywheel. One is to prove out performance. Once they do that, they earn advertisers' trust. That drives wallet consolidation and channel expansion. Basically, advertisers will spend more with them. This increased spend creates better signal density. The Trade Desk gets more data, so they learn and their platform gets better. That enhancement powers optimization and curation advantages. Again, they get better at pricing ads. That unlocks better supply and lower cost. You see, the flywheel is based on each turn making the next campaign better. Amazon can't break this. Amazon can't offer cross-channel measurement. They won't provide multi-publisher frequency control. These are things that advertisers care about, especially the big marquee, prestigious advertisers that the Trade Desk does business with. The reality is that the Trade Desk flywheel keeps spinning because these advertisers are locked in. They've integrated operations into the Trade Desk platform. You see, agencies prefer working with them. So it's not just the advertisers, it's also the agencies that advertisers work with. There are real network effects here. And the Trade Desk ROI is unmatched. We can just look. They shared in the earnings call another quarter where the largest advertisers increased budgets this quarter. Net revenue retention stayed rock solid. That means that customers are staying with them and spending more. If Amazon was breaking the flywheel, you'd see defections. It would be very clear in the data, and that's just not happening. Instead, you see expansion. So what do we have? We have the Trade Desk. This situation, they pass all filters. The market just handed you a playbook moment. Importantly, you now have tools: context check, divergence test, flywheel analysis. I strongly encourage you to watch my Monday.com analysis where the screen catches another one. Same pattern, same tools, same outcome. And remember, use this anytime you see big tech fear. I know it's going to happen again this quarter, this year, definitely within the next 6 to 12 months. It's a repeating pattern that they just can't shake.